So Lemonade Q3 results are out, and I feel like this GIF right here about sums up the quarter, about sums up the letter. If you don't have time to read a letter, just look at this GIF and study it closely, because this is what the letter at least felt like. In this video, we will look through the letter, give some of my take, point out some of the things I noticed, and also look through my model and see how this look at some of the detailed numbers of how this quarter came in. So Q3 2023, right away, the most important number we're looking at, the gross loss ratio, 83%. Of course, it was 94% last quarter, so a huge improvement. 83% here, huge relief to see that. A lot of uncertainty with catastrophic events and the sort of the degree of their magnitude, where that was going to end up, but huge positive number. I was looking for 87% or less, so 83%, really encouraging. Also beat on their premium, $719 in-force premium. This is versus their guidance of about $705 million in-force premium. And I don't really care about the exact quarterly predictions. I'm not really even trying to make predictions, but I was modeling out about $714 million in force premium, but they came in nicely, beat all of us at 718, which was really great to see. Also interesting, they have more customer growth, 1.984 million customers than I was expecting. I had put in, I was just again kind of guessing, but 1.945. So and they're at 1.984. So pretty significant beat there. They had 362 premium per customer versus I had, this is what I had before the quarter. This sort of blue lines at the top to cue us into that was 367. So a little bit slightly higher premium per customer, and they're a little bit lower premium per customer, quite a few more customers. So it tells me they're really attracting renters insurance, which is what they told us going back several quarters ago, that they were going to really target and go for renters insurance. By the way, if my voice sounds at all funny, I do apologize. I'm using a different mic than normal. I'm actually on vacation with the family right now and packed a different mic than I usually use. But anyways, it looks like they're really targeting. The numbers are telling us they're really pushing for renters insurance. So they're still getting an increase in premium per customer overall. And actually, this is why kind of longer term, going out, depending how they scale, how international they go, what their kind of growth trajectory is, long term, assume they're successful. I don't know if they'll become, as high a premium per customer as other insurers do in the U.S. right now, simply because I think Lemonade's always going to offer more niche insurance products that are really good on-ramps for younger customers to join in and and get their first insurance product from Lemonade and then grow with those customers from there. So that's always going to keep their premium per customer lower, but still nice to see that it is still, even in the midst of that, increasing. Here we are at this quarter, $362 premium per customer. And Q4, I haven't even updated any of my numbers yet, so we're kind of, we'll get to that later. I'll do more of a revamp on my model from 2023 here into, of course, the next 2 years, especially as they're targeting profitability, cash flow profitability in 2025. But stay tuned for that. That will come in the coming days. And of course, if you want to support my channel, you want full access to this model, you can get that by joining my Patreon and jump on there and get full access, play with the inputs in the model. You make your own copy, you do that yourself. Anyways, we're scrolling down through the letter here. This is a nice graph. It shows where their gross earned premium has really been rising from 80 to 136 to 173 dollars or 173 million over the last 2 years. But meanwhile, if you look at, especially this line, net loss as a percentage of gross earned premium, it went from 83% all the way to 36%. So you see this path towards profitability. I'm going to stop and point out on my model, this is a graph I added in the last few months, was adjusted EBITDA as a percentage of gross earned premium. So a similar type of metric where you can see all the way back to 2018, they're at like minus 275%. And then it has risen it continues to rise. Here we are in Q3 right here, we're now down to minus 27%. So we're 200% to minus 27%. It certainly looks like this machine, this organization is scaling, is continually moving towards profitability. That's why it's frustrating to me. I see some people make arguments, and literally their whole bearish arguments against Lemonade is they just say, yeah, they're not improving, their metrics sucks, they lose money on every customer. But it's like, well, but look at the facts. The facts are the underlying metrics are improving and continue to improve. So to me, those are the facts, and those are the facts I am basing my investment decisions on. They point out sort of a few highlights here. Of course, operating expenses are at $98 million. That's roughly where I was estimating them to be, but down a little bit. If you look across from a year prior, loss ratio we talked about, gross profit is increasing dramatically if you look year over year. Bottom line, $40 million loss, adjusted EBITDA loss improved 39%, net loss was $62 million, a 33% improvement. So, and they're actually guiding their guidance for adjusted EBITDA in this quarter was about $50 million loss. So huge beat on that line. That was when I first opened the quarter, 83%. I was very thrilled with that. And then I saw the $40 million adjusted EBITDA loss, was also very, very thrilled at that. They are showing that their loss ratio is trending down. That's a bit of a funny line here. They probably had fun writing this one. They continued the favorable trend we are seeing in recent quarters, which was rudely interrupted in Q2 2023. Go back to that pic of them just dunking on everybody with this letter. That's what it felt like when I was reading it. That's what it felt like. Little comments like that was rudely interrupted in Q2. That makes you chuckle, but I love it. I seriously, oh man, I'm very, very, very excited about the future of Lemonade and this quarter. Oh, this was an absolute slam dunk. So they're talking about we continue to make progress towards loss ratios that they're anticipating. They're sort of long-term loss ratios that they're anticipating. And then they're talking about 2 million customers and counting. This was interesting. I had mentioned again in my Q3 preview video they did a few days ago. I mentioned they might hit 2 million customers maybe by Q1 of next year, but they're actually saying that they'll probably hit that this month. So they're very close to that 2 million customer mark, which again goes back to, hey, they're probably getting a lot more renters insurance and maybe more pet customers as well, are being really aggressively adding those customer lines. But they have some nice metrics here. Time to add 1 million customers was 4.25 years, and now the next million was 2.75 years. Premium per customer within that increased 70%. Gross earned premium over that time grew 246%, and net loss as a percentage of gross earned premium roughly half, kind of like that pink graph we were looking at here, that pink line. Connecting the dots, the picture that emerges is a business that is adding customers faster, with each customer paying more, resulting in an expanding business and increasing efficiencies. That suggests solid progress along the path of profitability, which brings us to the next section. Then they ask about Investor Day, and they give a 12 months later ... Investor Day was about 12 months ago. It was a blast. If you happen to make it or can make it to the next Investor Day, hey, I encourage you to do so. It was really awesome to be there a year ago and meet so many other people that are passionate about the company. But I actually asked this question about, hey, how has profitability sort of been updated since Investor Day last quarter? I said, Investor Day, this was Q2. At Investor Day, you laid out a plan to reach profitability between 2025 and 2027. Fast forward a few quarters where you are now. How are you progressing? Can you give us a timeline update? And Shai said at that time, based on what we know, we're seeing little changes in our multi-year break-even timing. When we shared long-term financial scenarios in November 22 is before synthetic agent funding, before notable improvement in our EBITDA. So we plan to work that into our long-term planning and give a more updated view shortly. So not really much of an answer then at that time. Here we get our true answer in this next quarter. It says, it's been a year. We shared some of our overarching strategy. Things are in motion. And in the coming section, we'll add some more color. But we're happy to share we expect to turn cash flow positive in late 2025, considerably sooner than we had indicated last year, and expect to get there with hundreds of millions in unrestricted cash in the bank. Given the favorable cash flow dynamics of insurance, customers pay us before we pay them. Adjusted EBITDA profitability is expected to follow in 2026, a few quarters after our cash flow turns positive. So super exciting. Again, just dunking on everybody right now with this letter, and super exciting to see this, and for them to declare this and make this kind of adjustment. I mean, they don't have to disclose this information. No one's twisting their arm to do this, but to suggest this and say, hey, we're on track to do this, and the numbers, we go back to that graph that showed adjusted EBITDA as a percentage of gross earned premium. I mean, that intersected somewhere in 2025, sort of roughly around there. You kind of, it looks like, yeah, you could see 2025, 2026 is going to be, it could be when they're turning profitable. Then they have a little discussion here about technology as a core strategy, how they are really an engineering, vertically integrated engineering company at its core that's creating these super efficient systems and that can delight customers. So they give that, and they give a sort of a discussion again about that, a reminder about that they really feel this is their underlying competitive advantage. And they talk about the loss ratio, why it's been so challenging right now for insurers, just because of catastrophic events that seem to be growing, because of inflation that is just rampant, and the rates are not following that as fast as they should. Really challenging. And of course, they're doing everything they can to counteract that. And essentially just talking about here how what we've been talking about this channel and what Lemonade themselves have been talking about is that, hey, they're trying to increase rates, but those have to be improved before they can sell those policies to a new customer. So in the meantime, it takes time. There's a delay, and this delay but the delay only lasts so long, and then there's going to be a very positive effect. But this little very positive effect is coming, because you look at this little graph they give that auto insurance prices have been rising steadily. If you look, this is starting in September 2022, and U.S. industry-wide insurance prices have also been slowly rising, trying to follow that. But core inflation was high, but has been coming down. But essentially, you get this really positive trend. I mean, I've been doing some research that some people think vehicle prices are going to drop or suddenly kind of fall off a cliff a little bit and slide. And if you think about right now, they're trying to, if you crash your car and your insurer has to pay for a new car, but the price of a car keeps rising, well, that's going to really hurt your loss ratio, right? But if suddenly you're increasing your rates now to catch up to where the car was, and insurers are selling policies at that level to match that amount of risk and that amount of cost, but then say car prices do suddenly fall, then you have a really positive situation for your insurer, because now the cost to get the replacement vehicle drops substantially, even though you're actually overpaying, or maybe the whole industry is overpaying for what that sort of amount of risk should cost, just because insurance prices have to track higher. And then they move on to say, hey, we are increasing rates, and that's really important. But this is really important for somebody to understand if you're investing in an insurer, is ultimately what's even more important is being rate accurate and being able to predict, hey, what customers are the customers we want to keep, what are the customers we want to get rid of. And then they go on and talk about, hey, this slide from Investor Day where they talk about cohort lifetime loss ratio, which I've talked a lot about on this channel. I think that a lot of people get confused by what they mean, but this is, hey, for a cohort of customers, so it's all the customers that join Lemonade in a given quarter, what those customers' average loss ratio would be over the lifetime of those customers. And they're saying, hey, and then they're predicting that with their LTV AI model. So they're saying, hey, over time, these are getting better and better and better. A lot of people kind of wonder though, well, that's great, you're predicting that and that's your own predictions, but how good really are they? But then they give this nice actual comparison of, hey, in Q2 2022, we were predicting that the first year the loss ratio for that cohort was going to be 78%, and then it was exactly 78%. And their Q3 loss ratio they predicted would be, hey, for their first year, they thought it was going to be 71%, but it was actually 68% for those customers. So they're saying, but it means is those customers coming in the door are getting better and better. Of course, you have customers back here that weren't as good, and maybe they're predicting won't be as profitable as they sort of phase out, but the new customers that they're signing up, hey, they're even better customers than they were expecting. And then they talk about, hey, they're actually at LTV 9, or they're rolling out that model and continuing to improve this model and probably add the amount of data they're adding and adding the variables and data points to it. But with each iteration, they think they could predict this more and more accurately, which can tell them, hey, these are the exact houses and people and customers we really want to target and we really want to sell all of our products to, and these are the ones we don't. And they talk about their operating expenses, hey, that they are a tech company, that you may have higher fixed costs than you would otherwise, but those costs will provide a huge amount of operating leverage over time. And guess what? That's exactly what's happening there. In the last 24 months, gross earned premium grew 118%, while operating expenses increased a mere 19% in comparison. And they mentioned, this is interesting here, this dynamic is worth underlining. We're often asked why we focus on growth rather than profitability. We see that as a false dichotomy. Given our strategy of business and business architecture, Lemonade becomes profitable at scale. I mean, that's because they're paying more expensive engineers to make these AI systems. And sure, you could just fire all those engineers and not have that and build a more traditional insurance system, but then you wouldn't have these kind of operating leverages. You wouldn't have these kind of nuances and customer selections and LTV systems that are tracking and carefully trying to make better decisions about who is the right customer and who isn't. And again, they talk about, hey, these investments though you were making are front loaded, and so we might not see a perfect linear path to profitability. And then they talk about how they're made for AI, especially in the this age of ChatGPT, which is interesting. They talk about, hey, it's a mere fortnight later. Fortnight, is that 2 weeks, I think, with the launch. Correct me if I'm wrong, but launch of ChatGPT 2 weeks after their investor day a year ago. And really a moment where the public got it and understood potential of these AI language learning model systems. And they talk about 8 years ago, they really bet on AI and bots to become this efficient company that uses lots of generative AI. Generative AI, in short, is not a course change for us. It's accelerant along the very course we set at our exception. So it says, today we have LLMs trained to answer customer emails, review pet medical records, evaluate satellite and other imagery, read home condition reports, and more. We gave a sense of how AIs of all kinds enabled us to do more with less at our investor day, and things have accelerated since then. And then they basically mention here that, hey, a lot of people are asking how they're using generative AI, and they really are focused on this, is what I've been talking about as well, that just because they're quiet on it doesn't mean they're not working obsessively on these on this in detail, but they can't share more with us yet, or not ready to share more with us yet. And I love this sentence here then in sort of the closing paragraphs of the letter. Our ultimate goal is beyond being profitable. It's become an iconic global brand with unrivaled ability to quantify risk and service customers at the highest level of delight while shouldering the lowest cost to serve. This is why I've always felt like, hey, if Lemonade, they might be a risky company, but if they succeed, I think they'll do 100x or more, especially from where they're at right now. I think could be several 100x from the level they're at right now. That's at least my opinion. If they're successful, it's because they're in an industry where data is really important. So if you can create some kind of flywheel where you're gathering data and serving customers and then gathering more data, super, super powerful. But they're Also, an industry where somebody wanted to copy their business model, even had the capital to do so and jump behind them, it's difficult from a regulatory perspective. It's slow and cumbersome for that reason as well. So, being a first mover and being someone who's really looking as an insurtech, looking for the full package to fully serve the customer as they grow, I think is just a brilliant strategy. Okay, I want to just rip through my model here a little bit. I talked about some of this. I mean, some of this is just in the letter. Amount of premium, the gross loss ratio coming in at 83%. This area here is interesting. So we had 85% annual dollar retention, but customer churn, which I've been tracking, which I calculate based on what their how they define annual dollar retention. Customer churn from 12 months prior down to 17%. This was a big topic. Go back a couple years ago, was like it was in the 30-some%, and I mean that kind of freaked out a lot of people, thinking like, wow, customers just 30-some% leaves every year. Like, this is ridiculously unsustainable. But customers, we said at that time, us in sort of the Lemonade community at that time, as well as Lemonade's management as well, saying, hey, that's going to improve because they're going to have more products in more places, and they're selling less insurance and more other products, and more people can bundle and get all the products they want, and they're going to pick better customers and serve those customers better and ditch the customers they don't want anyways, and that number is going to improve. And now we're down to 17%. We'll bring up the graph of that. So I mean, back in 2020 they were close to 40%, and now they're at about 18% or just under 18%. So huge improvement in that domain right there. Not a concern at all anymore. This is also an interesting number: customer cost, their acquisition cost per customer. Now this is a bit of a guess because this is actually, I have out of the sales and marketing, which was 24 million. Part of that is fixed cost and part of that is variable cost. And the fixed cost has jumped around a bit. I've put in though 12 million, just roughly a little bit more than, or a little bit less than it was the quarter prior, and basically done a 50-50 split between how much is fixed, how much variable. At that level where we got that right now, that means they're actually only spending, it was like $78 per customer that they're getting. So really value, super efficient customer acquisition costs at that level. Of course, if there's less fixed and more CAC spend, that's going to get a little bit worse, but it seems reasonable based on the numbers we've had that it might come in at something like that. And then your customer acquisition spend, CAC spend for, and how much premium you get for dollar you spend is actually even better than last quarter. It's about 4.86. And again, that could just be that they're targeting those sort of more renters, more pet insurers like we've talked about. And they're getting really low-hanging fruit, these underserved customers that they can, for less money, attract and compete and win those customers. It also could be maybe just ad spend in general. I'm not an expert on this, but ad spend in general is down. So maybe they can advertise for less cost, less competitive advertising market to get a customer. Yeah, expenses, though, are other insurance. Again, 9% of GEP, of gross earned premium. Tech development was down, is now 13% of gross earned premium. G&A is at 21%, but it did have about a $6.7 million one-time expense related to Metro Mile. So I just want to 6.7. If I subtract 6.7 out of there, then you're down to the 18%. So again, a quarter-over-quarter improvement. If you have that subtracted out, you also have a total expenses as percent of gross earned premium, another from 57 to 53%. Of course, we have to include that, so I will subtract that back out. And then we're still at sort of level 57%. And actually, G&A actually went up slightly as a percentage of gross earned premium. And that's, again, sort of a one-time expense that will, of course, be going away. I'll just rip through a few of my graphs here as well. Share price, I don't have it shown until they sort of closer to maybe being profitable, and I haven't updated these further out years at all, but this is the picture. I'm looking towards that last paragraph of the letter where they talk about, hey, they want to be this iconic global brand. If that comes true, my thought then by the end, somewhere at the end of 2030, they could be like $1,000 a share, somewhere in that range. So roughly maybe around that 100x by the end of this decade, or at least by the end of 2030, actually that was. In-force premium over time, over history here, continues to rise. Again, showed you that churn graph where churn is continuing to drop. Expenses as a percentage of gross earned premium. Again, with that one-time expense still included, we're still here. If that was excluded, we'd be dropping a little bit further. Adjusted EBITDA as a percentage of gross earned premium continues its climb. I also want to touch on their guidance for Q4. So with this beat across the board, they've also, of course, improved their guidance in a sort of a relative way. It's not a huge improvement, and Lemonade basically always beats their guidance by a little bit. Consistently always beats their guidance. They pointed it out at Investor Day. I remember how it was like basically every single quarter had beat their guidance. I don't have all that history in front of me at this exact moment, but they're guiding for a slightly worse adjusted EBITDA loss from the 40 million to 42 to 44. I'm going to guess they're probably going to beat that again. And this is, again, being conservative. Then they moved up their in-force premium, gross earned premium revenue in a relative way. Actually, I do remember, if you go back to Q4 2022, so Q4 of last year, that was a while ago now, but all the way down to their guidance, that was the quarter they had super bad guidance for 2023. Not bad, but really, really conservative guidance. An adjusted EBITDA of $245 million to $240 million loss. And the investors were just really, really frustrated and really, really sour about this. And I think I had a video or two at the time, just discussions about, hey, this is probably really sandbagged. This actually doesn't even make sense when I modeled out. Like, you have to be really, really conservative. And I think at that time I was saying, I'd have to go back, but I thought it was saying, hey, I think it's more likely they're going to do like $180 million adjusted EBITDA for the year. And here they are now, a few quarters later, saying they're going to be more like that $186-188 million range. And again, there's probably a good chance they even beat this and beat these numbers in Q4. So yeah, super exciting quarter for me as a Lemonade investor, as I'm sure many of you watching feel. This is like pop the champagne kind of moment right now. And if you haven't bought more shares, I know not financial advice, but I will definitely be planning to buy more shares. I have been slowly buying shares the entire time, but I would definitely be loading the boat even higher after a quarter like this, because you're just seeing the fruit. Before we're seeing all these underlying metrics kind of come together, but now you're really starting to see this, like the fruit of those. Before, it was sort of more like the seeds or like the flowering of the fruit was coming, and it wasn't as clear and obvious. But I still feel like it's becoming more clear and more obvious, and I feel like the potential for Lemonade is just so massive that. This is another thing I've said throughout many of my videos, is that, hey, even if they start to show signs of success, even if the stock, like we have a short squeeze and the stock like quadruples and goes to, $50, $45, $50 a share, which who knows what's going to happen. But even if that does happen, I still feel like there could be, as they prove themselves quarter after quarter, there could be huge amounts of buying opportunities for a very long time. Like, if you're a long-term investor, if you're thinking long-term. So that's how I view it, and super excited for the quarter. Also super excited for the earnings call tomorrow morning. And thank you so much for watching. Let me know what you thought in the comments down below. And remember, it's in the bag.